In this video, we're looking at private equity performance relative to public equity performance and looking at two studies that help us understand some key differences between the two. On a headline basis, private equity performance looks strong, with Cambridge Associates data showing 25-year returns for private equity of 12% per year versus public equities only 9% per year. So headline basis, you say, wow, private equity sounds pretty good. But let's dive into these two studies to see what we learned. The first study we're going to look at was from Yale's investment office run by David Swensen. He dug into 542 private equity deals that got pitched to Yale during his time there, and they compared the performance of those deals relative to public stocks to get apples-to-apples comparison. So on a headline basis, those 542 deals earned 36% annualized returns net of fees, while the S&P 500, adjusted for timing of investment and size of investment, returned 17% per year. So headline basis, you say private equity 36, public equity 17, private equity wins. But here's the key. They adjusted that 17% annual return for the S&P 500 for leverage because the private equity firms are buying these companies and issuing debt to juice the returns, which increases the risk profile relative to public equities. So David Swensen and his team said, what if we adjust the S&P 500 for the balance sheet leverage amounts of these portfolio companies owned by the private equity firms? Well, guess what? 17% annualized returns for public equities goes to 86% per year. So you go from half the return levels of the private equity firms for the S&P 500 to winning by more than 50% per year when you adjust for leverage, which increases the risk of these companies and therefore the investments. A risk-adjusted basis, David Swensen's study shows public equities look very strong. The second study we're going to look at is from Dan Rasmussen's book, The Humble Investor, where he dug into almost 1,000 deals where private equity firms bought companies and issued public debt and therefore issued public financials both before and after the deal. Here's why that's important. Dan's thesis going into this study was, let's see how private equity firms take companies before the acquisition and improve their performance after the acquisition to drive returns for their holdings over time. Here's where it gets interesting. Dan and his team looked at almost 1,000 deals and saw no noticeable difference in fundamental performance improvement from before the deal to after. The only thing that stuck out from his analysis was higher levels of debt after the deal relative to before. So private equity companies come in, buy companies, issue debt to buy those companies, and increase the leverage of those companies' balance sheets after the deal. So the standard or the sample size of 1,000 deals for Dan went from in line with peer leverage levels on an industry by industry basis to almost 2 turns of leverage higher after the deal. So if we look at Dan Rasmussen's study and the Yale study, we see private equity firms tend to increase the leverage of the companies that they buy. And if we adjust public equities for those higher leverage levels, performance looks very strong for public equities. Not to say that private equity managers can't do a good job, and in fact we see a very high dispersion showing the top performing funds doing very well over time, but if we're comparing apples to apples for the overall asset class, public equities on a risk-adjusted basis look really strong.